If you are doing these things inside of a tax-free savings account, it is likely costing you money and is leading to subpar returns overall. In this video, I'm going to be explaining some of the biggest mistakes I've seen inside of a TFSA over my 16 plus years as a self-directed investor and around 10 years of running Stocktrades.ca. Now, you might think that there is a ton of videos on this subject on YouTube, and you would be absolutely correct. However, I'm going to be diving into some things that I have never seen mentioned on any of these videos. I'm going to be taking a bit of a different perspective on a lot of TFSA issues I've seen over the years. This isn't going to be your standard, don't use it as a cash savings account, don't over-contribute, things like that. Instead, this is going to be a video that focuses on some intricacies that people may have never heard of. My name is Dan Kent. I'm one of the co-founders of Stocktrades.ca and one of the hosts of the Canadian Investor Podcast. And I'm going to dive into some huge TFSA mistakes I see investors make over and over again in this video. Now, before I start, if you liked the video, head down below, like it, subscribe to the channel. We're heading to 20,000 subscribers here, and I'm hoping we can hit it really soon. And if you're interested in 3 potential options for your TFSA, I will leave a link in the description below. You can grab that report absolutely free. So mistake number 1, and this is probably one of the most common mistakes I see with investors in a TFSA, particularly those who are newer to investing and probably haven't made this mistake yet. This is a mistake I even made when the TFSA first came out in 2009, 2008, 2009, and I was contributing to it and making highly speculative investments. So I like to call highly speculative investments, regardless if they're in a TFSA or not, scratch-off tickets. And the main reason for this is if you head to a gas station and you buy a scratch-off ticket, what are your likely results? Some of the time you're going to come out ahead. You might double your money, triple your money on that ticket. Sometimes you're going to break even. They probably give you a free ticket. Maybe you get your money back. But the vast majority of the time, you're going to scratch that thing. You're going to lose all your money and you're going to regret buying it. And a lot of the time, these speculative stocks are the exact same thing. You win on very few, you break even on some, and you lose on most. And the difficulty with doing this inside of a tax-free savings account is your contribution room is limited. You get, let's say in 2025, you're going to get $7,000. If you lose that $7,000, that money does not come back. It's not, in the case of a scratch-off ticket, you can just, go back, spend $10 again and keep spending that money until you maybe find a winner. But in the TFSA, once you blow that contribution room, it's over. You don't get it back. So I see a lot of investors over the years, again, particularly new ones, they will buy a speculative stock in their TFSA. They will lose 50% of that money, 60% of that money, in some disastrous cases, the vast majority of that money. And then what they'll do is they will sell that stock and they will maybe learn their lesson and then buy, say, a broad-based index fund or a blue chip Canadian stock and start earning from that. The difficulty here is the amplification in terms of lost returns. And over the long term, this can compound substantially. So let's say we get that investor who contributes to their TFSA. They're going to buy a blue chip stock or a broad-based ETF with their $7,000 contributions or whatever it is when you're currently watching this video. And they earn 8% a year over the next 25 years. They will have just shy of $51,000 from that $7,000 contribution over the next 25 years. So we're talking big returns here on your capital. You do that every year over a 25-year period. You buy that $7,000 worth of stock. It will obviously go up as we move forward because the TFSA contributions do adjust in terms of inflation. But overall, what you can take from this is there's large money to be earned from even, modest returns in your TFSA, especially when you talk about contributing on an annual basis. However, what happens to that investor when they take that $7,000 contribution, they invest it in a speculative stock over the allure of tax-free gains? They think they're going to take that $7,000, find some 10-bagger and, make $70,000 over the next year or two. What happens if that goes south and that $7,000 turns into, let's say, $3,000? So you had $7,000, you have $3,000 now, and you finally kind of learn your lesson after you take that big hit, and you take that $3,000 you have left over and buy a blue chip Canadian stock or ETF that earns 8% over the next 25 years. After that 25-year time period, you will have $21,000, which is a fairly reasonable return on that $3,000. But the only difference here is you're going from the 50-some thousand dollars you would have had you had done the right thing first, and now you're looking at $21,000, so about $30,000 less on that small of an investment. That is a monumental difference in returns, and it can really start to compound in your tax-free savings account, which could actually impact your overall ability to fund your retirement. This is a fairly serious investment vehicle. It is the biggest opportunity Canadians have to achieve tax-free growth, and actually being relatively conservative in this account you will be better off than being hyper aggressive, which I see so many people do. One of the biggest examples I have is I had a friend back in 2019. He lost $35,000 on a speculative investment in his TFSA. He lost nearly all of it on pretty much a biopharma company that, was in clinical trial stage. That will turn out to be a monumental amount of money over the next 25 years. In fact, if that $30,000 instead would have earned 8% annually over the next 25 years, it would have worked out to be $220,000. Now he has nothing because he doesn't get that contribution back. So that would by far be the biggest mistake I see people make over and over again, and I see it all the time with whether it be cryptocurrencies, speculative stocks, derivative-based investments, single stock ETFs that are based on derivatives, leveraged ETFs, things like this. Avoid all that in your TFSA and just stick to a relatively conservative strategy that is going to bring you average market returns, and you're going to have a boatload of money in retirement you can pull out tax-free. So speaking of taxes, the second biggest mistake I see investors make is doing absolutely anything they can to avoid taxation. And one of the main things in the tax-free savings account is the fact that U.S. dividend stocks are subject to withholding tax, a 15% withholding tax on the dividends. So this more so comes into play for those who don't have RSPs, or it might not be tax beneficial to own RSPs where you can tax shelter those U.S. dividend stocks. But I also see a lot of people hyper concentrate their TFSAs in a particular country, that being Canada, just because they want to avoid that withholding tax, even if they do have RSPs and own U.S. dividend stocks in there. I will tell you right now, I own a lot of U.S. dividend paying stocks in my RSP, and I own them also in my TFSA. It is really not that big of a deal. What is a big deal is heavily concentrating your TFSA in Canadian dividend paying stocks because you don't want to pay that 15% withholding tax. You either buy a broad-based TSX ETF, or you are buying a lot of blue chip Canadian companies, or even Canadian companies that don't really pay dividends. But there aren't really a lot of large cap companies in Canada that don't pay dividends. It's kind of the way our economy is structured relative to the United States, which has a ton of large and mega cap companies that pay rock solid dividends and still grow at a double digit pace. But what people will do is they don't want to pay that, 15 cents on every $1 in dividend you earn. So they just will structure their TFSAs to be 100% Canadian equity in order to avoid this tax. Now, if your portfolio is allocated correctly outside of the TFSA, let's say you have an RSP that has a lot of US stocks, it's structured correctly, your allocations are all right, sure, you can, go all Canadian inside of your TFSA if it results in a properly allocated portfolio. But what I will see is a lot of people just defer owning US stocks, period. So their RSP, it's not tax advantageous for them to contribute to the RSP, so they just don't have one. They'll have, say, a taxable account and a TFSA. They will opt out of owning U.S. equities, which have historically grown at a faster pace than Canadian equities, and they will instead structure their portfolio for 100% tax mitigation, when in reality, maybe owning that S&P 500 ETF or those US dividend payers inside of that TFSA would have led to higher returns even after you lost that 15% withholding tax. I see way too many people worry too much about this withholding tax. I mean, I own companies like Starbucks in my TFSA. I have Google in my TFSA, Lockheed Martin in my TFSA. I also have chunks of those companies in my RRSP, but obviously my RRSPs are maxed. So at that point, I'm unable to add any more US dividend payers in my RRSP, but I still choose to add them in my TFSA because the 15% withholding tax to me is not worth the potential lost growth of not having exposure to US equities in that account. Now, obviously, this mistake comes a lot at the expense of your overall portfolio allocation. A lot of people can have a properly allocated portfolio and have their TFSAs 100% Canadian equities. But all I'm saying is don't fuss over a 15% withholding tax if you want to own US equities inside your TFSA. If you find they are a better opportunity, just put them in your TFSA. It is not a massive deal. If you have the flexibility in your portfolio to kind of allocate particular stocks to particular accounts, and you can get away with still being properly allocated with your TFSA being 100% Canadian stocks, then that's a very good situation. But a lot of the people will not be in that situation, especially those who are just starting out. They might find they're in an income bracket where the RRSP doesn't make sense and the TFSA is the much more tax beneficial vehicle, but they'll just own Canadian stocks because they've been taught to avoid taxes at all levels, and eventually they'll just end up with a portfolio that it's way too heavily allocated to Canadian equities, and as a result, they might end up underperforming. So the third mistake, and is one that I see all the time as well, is people tend to think of the TFSA as a vehicle where you need to maximize the returns by going 100% equity at all times. And this might be a situation that is more relevant to people closer to retirement, but there is justifiable reasons to own fixed income investments, whether it be high interest savings ETFs, whether it be GICs, whether it be actual bonds. A lot of people tend to think that these are kind of a waste of space for the tax-free savings account. And again, this all comes down to portfolio allocation. But if you are not looking to run a 100% equity portfolio, it makes complete sense to possibly tax shelter some of those fixed income investments in a tax-free savings account over, let's say, a taxable account or an RRSP, because they're truly tax-free. You're taking one of the most inefficient investment vehicles in terms of a taxation perspective in fixed income, and you're putting it in a tax-free savings account, which ultimately will allow you to earn that income tax-free, but also is much more flexible from a withdrawal perspective. If we look to something like the RRSP, you are taxed as normal income when you withdraw that money from the RRSP, whereas the TFSA is tax-free at all times, which makes it a lot more flexible in terms of withdrawals. You can pull that money out of your high-interest savings ETF or your, I guess, not necessarily a GIC because that would have a maturity date, but even then, a maturity date in an RSP, the GIC would mature, you'd withdraw it, and you'd pay tax on that income, whereas a TFSA, it would be tax-free. So we have to think of our portfolio as one giant element. And if you're looking to maybe run an 80-20 mix, equity fixed income, a 60-40, something like that, you're getting closer to retirement. You're not necessarily looking to maximize those gains, but more so have some cash buffers in retirement, maybe mitigate that sequence of returns risk with some fixed income, some cash buffers, things like that. The TFSA makes a lot of sense as a vehicle to actually use to generate tax-free income from those investments rather than hold them in an RSP, which would be taxed upon withdrawal, or the worst case from a taxation perspective is hold them in a taxable account where there's probably not going to be a lot of capital losses that you could take advantage of. I guess this would be the case in a situation where you didn't hold a bond to maturity and could sell it at a loss, or a bond ETF. For the most part, your principal is guaranteed, which is why you are taxed a much higher amount on the income. It's the poorest form of investment income. And if you have it in a taxable account, you're going to be taxed, whereas dividend stocks are taxed, especially Canadian ones, are tax very friendly in a taxable account. So maybe you could switch that to have more fixed income in that TFSA, and you could have your dividend stocks in that taxable account. Obviously, this is going to depend heavily on your overall situation, your tax situation, your investment goals, your time horizon, things like that. But the mistake I guess I'm saying here is your TFSA does not need to be an all equity, maximize returns at every single stage situation. But a lot of investors feel this way because they don't want to necessarily give up the higher tax-free returns over opting for a more conservative strategy in that account and tax sheltering investments that might not be the most tax friendly. So everybody, that's it for the video. Hope you like it. Head down below, subscribe to the channel, like the video, drop a comment. Did you make any of these mistakes, or are you still making these mistakes inside your TFSA? And I hope you can support the channel on the path to 20,000 subscribers. I hope to hit it very soon, but I need your support to do that. And again, there is a free report down in the description, which provides 3 stocks that I do feel are pretty rock solid opportunities in a tax-free savings account right now. And as always, everybody, stay tuned for more great investing content.